To sum up in one sentence, evolution of gift cities is a revolution. With this, I now request Mr. Padmanabhan sir to introduce next the keynote session speaker, Dr. Viral Acharya. Over to you, sir.
Thank you very much. Thank you, Bijur. And good evening, ladies and gentlemen. Good morning to Viral. I think this is a session we are looking forward. Dr. Viral Acharya is a CV star professor of economics in the Department of Finance at New York Stern School of Business and an academic advisor to the Federal Reserve Banks of both New York and Philadelphia. He was a deputy governor of the Reserve Bank of India from January 2017 to July 2019. His primary research interest is in theoretical and empirical analysis of systemic risk of the financial sector and its regulation. A brilliant mind, a great academician. I first met him in Reserve Bank of India when I was a chairman Bank of India. I had left Reserve Bank by that time. Viral came in after I had left. And I was immediately captivated at the very first meeting by his clarity in thinking, the depth of understanding, and his almost frenetic demand for data before decision making. But what fascinated me the most was his courage of conviction and speaking out his mind, not mincing words. Honestly, I saw a lot of me in him in this respect. Some of his speeches are well known. He did not please some, but he won huge professional respect, and he quit before completing his tenure at his own terms. Most of us know all this. But what we do not know, or most of you do not know, is that Viral is passionate about tennis. He is an avid tennis player. One of my continuing regrets is that I never got to play with him while he was in Mumbai. Maybe we will get a chance sometime in future. Another interest we share is music. All types of music. I think I have bored him with forwarding even some of the South Indian songs, but he's such a, his understanding of music is so vast that he comes back with comments which are just spot on. In fact, he's not only a connoisseur of music, but he sings normally Kishore Kumar songs. I think there was a brilliant interview which made everyone laugh, which is there in the YouTube with Tamal Bandyopadhyay. Those of you wanting to, he explains even the concept of economics and monetary policy and the relationship between the government and the Reserve Bank of India with some Kishore Kumar songs. Welcome, Viral. Thank you for agreeing to deliver this keynote address rather early in New York, and particular thanks for agreeing to come in at this time. Understand that you're going to talk about banking for $1 billion and India's digital lending journey for financial inclusion. We really look forward to your address. Viral, we have about 40 minutes. I think at the end of it, if you have a couple of questions, we can take those questions as well. Without much ado and wasting any more time, over to Viral.
Thank you so much, Paddy, for that generous introduction. I'm always delighted to receive the music snippets from you, so please do keep sending them. As Paddy mentioned, I wanted to talk today about banking for $1 billion plus, India's digital leapfrog for financial inclusion. And this is a presentation that I've been working on with the iSprit team, Sharat Sharma, Kamya Chandra, Tanuj Bhojwani, who have been behind the development of India Stack. I'll, of course, explain for those who are unaware what India Stack is, what exactly that is. The reason why I picked this topic is because many of us in academia, just recently I was talking to Professor Ishwar Prasad of Cornell University, who has written an excellent book on digital finance. We are actually quite impressed with the digital infrastructure India has put in place for lending of the modern times, or of the sharing economy. I've called it banking for $1 billion plus. Sometimes I think about it as embedded finance, where finance is embedded in the ecosystem of the businesses or the borrowers. But let me just put things in perspective. While India has made many strides in financial inclusion since 1950s and 60s, it's fair to say that about 15 years back, these stats on some fronts were still not that attractive. For example, only 17% of India in terms of population had bank accounts, only 15% used digital payments. And one reason why digital payments is exciting to many, and certainly to people like Ishwar Prasad and me, is not because of other things that people are talking about, like crypto assets and things like that, but because it has the possibility of reaching the last mile in a much, much faster and efficient way than what might have been possible with the traditional modes of banking. To just put one thing in perspective, by 2021, about 81% of India now have bank accounts in terms of population. Now, of course, that doesn't necessarily have to do just with the payment systems. There are many other things that have happened along the way. But I think it's fair to say that one exciting possibility for accelerating and harnessing the potential of financial inclusion is to go down the path of digital finance. Now, why I think India is uniquely positioned to harness the potential of digital finance is not necessarily because of its demographics, or not necessarily because of the nature of its banks and other financial intermediaries. We think it's because of a fundamental change that has happened in the financial infrastructure. And it has been developed, unlike in other countries, as a public good. So let me explain by what I have in mind, is that in many countries, the digital payment system has evolved in a private manner, where each bank is developing its own digital payments infrastructure, or a large e-commerce platform, such as in China, is developing its own digital infrastructure. This digital infrastructure is then not portable when you go from one bank to another bank, or when you go from one e-commerce platform to another e-commerce platform. In contrast, in case of India, much of the digital infrastructure has been developed as a uniform platform over which banks, intermediaries, borrowers, sharing platforms all interact. And this digital infrastructure has been developed as a public good. It is not owned by an individual public company. And this is India Stack, as it's called in the space of software or the digital finance parlance. What is India Stack? It's a set of connectors. It's a set of digital software connectors. It's an open technology, what in the programming world gets called as APIs or standards, for three critical things to make financial inclusion more efficiently achievable. That's to obtain and verify the identity of the parties involved in a financial transaction, to settle the payments between them, and then encapsulate the data about the borrower and the lender with the right sort of consent architecture in that space. And these three aspects, the identity verification, the settlement of the payments, and encapsulation of the data for future purposes, is what then is likely to enable banks, non-bank finance companies to provide various aspects of financial inclusion, create accounts, provide payment services, and most importantly, expand the space of credit, which paradoxically in India, while India has a very high non-performing assets problem historically, it's also actually underpenetrated as far as credit is concerned. This is a little bit the opposite of China, where yes, NPA problems are large, but actually China has an overabundance of credit in a social credit sense. So just to layer these aspects of digital infrastructure, the public digital infrastructure that India Stack has provided, as I mentioned, there's an identity layer. We, of course, all know what this is. This is the Aadhaar or the UID system that India has implemented. It's a public good. Then there is a payment settlement system through the Universal Payment Interface, the UPI. And then there is the data layer on top of that, which is the most exciting one, and which is where I think India stands right now. India is now over the identity layer and the payments layer in terms of optimizing them, getting them to be widely embraced. A series of changes especially have led to digital payments, I would say almost close to exploding in the last 5 years. And this infrastructure, I think, thanks to the vision of some people at the iSprit team, of course, through, I think, the championing by Nandan Nilekani, has really developed in what one can consider an extremely modular fashion. What I'm always impressed by when I talk to the team that has developed this, as to how organized is their approach. In fact, many Indians are not aware, but the technology that underlies Aadhaar, UID, and its verification is now being developed into a common use open source platform where other countries, poorer countries of the world that are unable to afford the Canadian or the French tech companies to implement UIDs for them, they are going to be able to take as the basic software an open source software for implementation of UID and its verification in their countries. Now, this is tremendous. India is going to be potentially enabling financial inclusion, not just in India, but in many poorer countries which are unable to afford private solutions to actually achieve this, because getting that software developed through a private company would cost tremendous amounts of money. And this has all been developed in a very, very modular fashion. And that is when, after a while, suddenly the complementarities across these modules can potentially lead to an explosion of possibilities, in my view. It's a little bit like, in chess, you first learn to move individual pieces, but then you start doing combinations. And then you suddenly realize, wow, such complex strategies are possible to do that. And I think something similar, India is at the cusp of something similar in digital finance, in my view. So as you know, at the identity layer, we had the Aadhaar, then we had the eKYC, and now you can actually digitally verify and sign documents. So that's e-sign. In the payments layer, you have a variety of initial innovations, but ultimately that has led to UPI, which is, I think, the most important breakthrough as far as having a standard for settlement of payments is concerned. And I can tell you, doing digital payments in other parts of the world, that India's infrastructure in payments is probably next to none. I think it towers above everything else with its universality of application. And then now you have the next possibility, which is the data layer, where you can create digital lockers where a potential user or borrower can lock various aspects of data into a common place. You can have a consent architecture where, as a potential borrower, I can authenticate which parts of the data I want a lender, a potential lender to use, or someone who's doing a KYC to use. Of course, as a borrower, if I selectively cherry pick what I'm giving to the lender can factor that in, ration me, or give me credit at the right price or at a more expensive price based on the integrity and comprehensiveness of the data that I've provided. But the important point is that it's a consent-based architecture that's now possible. And then you have the possibility of account aggregator, which is that as a borrower, I can put together in a single view, in a single sort of digital view for the lenders, what are my various assets? What are my mutual fund positions? What are my insurance and pension holdings, direct and indirect holdings of stocks? What are my bank balances? What may be some collateral that I have in terms of account receivables? What is the information collateral I have in terms of my past transactions and the validation of those transactions, their ticket size, their frequency, etc., etc. And seeing all this, potentially a lender can run the new sophisticated credit scoring models. They may be based on machine learning, AI, etc., etc. So I think in some sense, the phase one of this digital infrastructure revolution in India was the plumbing, these three layers, and making them feasible in an extremely modular manner so that anyone who wants to jump in and become a player in this space has the individual pieces of the chess and now can combine them into a complex, feasible strategy. The phase two is exactly that phase of combinations. It's of financial services, which can now combine these infrastructure in a variety of novel ways to provide credit, to provide insurance, to facilitate financial investments. And I think in addition to Account Aggregator, which has just been launched, there is another component of the plumbing which is being developed, which is called as OCEN, Open Credit Enabled Network, which I think is another part of India Stack APIs, and that's going to be very, very crucial going forward. Okay, so let's just now think a little bit about where all this is headed. Okay. Historically, if you spoke to lenders in India, they said, we are asset-based lenders. You show us collateral, you tell us what your assets are, what's the left-hand side of your balance sheet. We'll do some assessment of that. We'll come up with collateral valuation, and we essentially lend on basis of that. Now, you can imagine that many small businesses, which are primarily in a total proportion sense, are primarily services. Most MSMEs are service providers. They typically don't have as much physical collateral as the large brick and mortar companies. In fact, many would argue that even our large companies today don't have as much tangible collateral, they have more intangible collateral. But certainly in case of SMEs, physical collateral is not a big part of what they do. So their collateral is actually information collateral. What's your customer flow? What have been your transactions? What has been the ticket size of that? Are you managing your payments well? Are you receiving your account receivables in a timely manner? Are you making your account payables in a timely manner? So it's information in those transactions which is actually key to making smaller loans. In fact, it's very instructive. Paddy mentioned Tamal Bandopadhyay. When I was at RBI, Tamal Bandopadhyay had taken me to see some of the microfinance lenders, how they actually work. And it's very fascinating. They understand for each small borrower, for borrowers who are less than 1 lakh rupees of loans, what exactly is the pattern of their cash flows. And to start with, they give you small ticket loan for a small maturity. They figure out if you are able to meet the payments, and gradually the borrower builds reputation, enabling him or her to borrow longer and for larger amounts. So that is the information collateral. At a microfinance lender, that is encapsulated because the microfinance lender has that reach. Now, much of the deposits of India are sitting in the large lenders. For them to extend those into credit transactions, we need them to be able to assess information well rather than just physical collateral. And this is where the idea of the account aggregator comes in, which is, can the various aspects that a borrower is involved in be put together digitally in the form of a view or a snapshot at a given point of time? Of course, it's a snapshot, but information is encapsulated potentially historically as well. And What all is this information? As I said, it's your accounts in various kinds of financial investments. It's your business data. It's your transaction flow. It's your financial flows. All of this potentially can be put into an account aggregator. Of course, that account aggregator has to respect data integrity, has to respect data privacy, and the legal framework for that is currently in the works. But once you have that, the account aggregator, which on one side is receiving information from bank accounts, mutual fund houses, insurance provider, tax GST platform, etc. That information, with the consent of the borrower at the top, can then flow to the right-hand side to the financial information users, those who are likely to be doing AI, machine learning, or some other kinds of credit scoring methods with back-tested performance evaluation. This can lead to transaction flow-based credit, so switching over to cash flow-based credit rather than asset-based credit, which is what typically our lenders have done. It can expand personal finance management, providing investors with a suite of household wealth management softwares. And potentially the AI could come in even in other forms such as robo-advisors and so on. In fact, Deputy Governor Rajeshwar Rao, with whom I had the pleasure of working when I was at the RBI, recently sort of released AA, sort of launched the account aggregator framework. And you can see that several banks and public sector banks have also joined this enterprise now. So this is a real possibility as we speak. My one sort of lament, if I could add in, is that when I was at the RBI, some of us wanted to put in place a public credit registry. So account aggregator is an aggregator of assets of the borrower. I think it's also important to have an aggregation of the liabilities of the borrower so that the borrower is not pledging the same collateral to multiple lenders. Potential lenders would want to know what are the various liabilities that you have, what has been your track record on all of this. I would have preferred if we had gone ahead and implemented a public credit registry. I have no knowledge of it anymore, but it seems to have stalled and not made much progress. Perhaps the view is that the private credit bureaus will do just a fine job. My sense was that the data there were not comprehensive, and they were not comprehensive in terms of coverage of borrowers. They were also not comprehensive in terms of showing all liabilities of a given borrower, both of which are crucial. One, for development of robust credit scoring models, and second, for ensuring that the borrower is not over-pledging collateral to multiple potential lenders. Now, the one important aspect of this account aggregator infrastructure development is that this will reduce the lack of trust, especially at the small ticket loans. As I said, what is the typical problem with a small ticket loan? That the borrower is deep inside the alley or the street of some rural area, and banks, which are the primary sort of pools of savings of the economy, are sitting far out with their branch and loan officers. In fact, very often banks have to hire third-party loan selling agents, or they have to hire third-party collection agents in order to interact with the potential borrower in the rural area. Now, why should we expect that if everything is being done through a third party, you will get a ton of financial inclusion? That third party neither knows the bank very well, that third party neither knows the borrower very well. Ideally, you want to embed finance in the ecosystem of the borrower. If it's a small or micro or medium-sized enterprise, can finance be embedded into the ecosystem where this business is operating in the first place? And I think this is now a real possibility. Discovering who are the creditworthy borrowers in the ecosystem where they are functioning, instead of having a distrust, which has been a part of the problem over these borrowers, account aggregator can actually, just like Aadhaar verification, can provide verification of your assets data. And in fact, suppose that instead of doing the selling of the loan and the collection on the loan through a third-party agent, suppose that entire transaction is embedded on an e-commerce platform where this MSE is operating. Now you also have a very efficient way of collection of cash flows. One, because the borrower cares about the reputation on that platform. That's the source of revenues for the borrower. And second, the e-commerce platform has all the incentives for this to work well, because they can just collect the payment, transfer it over to the potential lender, and this way they are layering also a financial service on the e-commerce platform beyond just the commercial service that they are providing to the borrower in terms of connecting them to their potential customers. So I think this is the next sort of frontier in my view. Can these sharing economy platforms, tax and legal filing apps, Kirana Tech, e-commerce platforms, can some of these now become the equivalents of the loan selling agents? Can they become the intermediaries that are still taking the loans that are potentially provided by banks, NBFCs, etc., but become a platform through which these loans are provided to the MSMEs and smaller borrowers, and through which the collection of payments potentially is also made. So the idea is to embed the credit offers and the timely repayment. So on these platforms, not that they are becoming banks. I think it would be a mistake in my view to make these e-commerce platforms the banks, because there's a tremendous conflict of interest that arises, but to make them just the intermediaries through which the products that the banks and NBFCs are willing to offer to a borrower can be made available to the borrower. And then, because the e-commerce platform is involved in the digital payments and settlements of the transactions of this borrower, to encapsulate the repayment on the loans on these e-commerce platforms as well. And this is where OCEN comes in. For this to work well, you need a couple of things. If a borrower has unique access to the information of a if a lender has unique access to the information of a small borrower, usually what is observed is that they gouge the borrower. They charge very, very high rates. Think of the problem we have with money lenders, etc., in the informal lending system. You want relatively portable access. What do I mean by that? That a new lender that wants to come in to the ecosystem of a MSME and start lending to them should be able to come in with relatively unfettered access to the account aggregator and other transaction cash flow information that the MSME has. In other words, the MSME's information should be portable from one platform to the other, from one bank to another. So neither the e-commerce platform nor the lenders should develop an information monopoly over this MSME over a period of time. Now, if each payment network's settlement of transactions and exchange of information is organized privately, so that one bank, the way it collects information and settles the payment is on its own network, and another bank then has on its own network, then you can't have portability, because you are not operating with a common standard. You are embedded now just in the microcosm of one bank and a borrower and one e-commerce platform. You are stuck there, so to speak. What OCEN, the Open Credit Enablement Network, plans to facilitate is to create a common bridge. So you can see a bridge here in the schematic, which is a common bridge between the lenders and these e-commerce platforms, which are in turn facing the ultimate borrowers and the MSMEs on the right-hand side. So that along this OCEN, anyone who wants to be a new entrant, whether it's an e-commerce platform in the middle or whether it's a bank on the origination of credit, they can essentially enter this using the same set of APIs or modules that India Stack has developed, connecting them to the ultimate borrower in a portable manner as far as borrower's information is concerned. This competition is what, in my view, will lead to expansion of credit, extend credit at the extensive margin of credit. A lot of our small businesses are not in the formal digital network, and this competition can enable them to become parts of this. So just to give you an example, on the government e-marketplace, a new app has been developed called the Sahay GEM that combines account aggregator and OCEN. It's like, as I said, it's like a combination of modules now in order to accelerate MSME credit. A potential borrower, such as on the screen, has just received a 520 rupee loan based on the information that they are able to provide on their cash flows. Now, if this can be done digitally on the phone, including identity verification, e-signing, verification of information about the borrower, etc., and with multiple banks offering potentially credit to this borrower, I think that's potentially very exciting for financial inclusion going forward. So let me just summarize, and I'll end with a few final words of caution. My mind is always about sort of doing things in a prudential risk management framework rather than just going for growth in an uncheckered manner. But as far as the potential of this concerned is that all of these MSMEs and the potential lenders in India, they are all organized right now sort of in a bit of a chaos. It kind of works, but it only works for a smaller set of players, and it's all very fragmented. The idea of the India Stack and the digital infrastructure, the public digital infrastructure that's been created, is to make this more organized so that it's replicable, it's scalable, and it can expand credit at the extensive margin of the borrowers. It can enable more borrowers to be in this network. This way, banks and NBFCs in some cases who have low cost of capital because they are the pools of savings of the economy can connect with a second tier of intermediaries who are embedded in the ecosystem of the MSMEs who are now on the outer fringes. Of course, there could be some crisscross here because the same MSME in one dimension is working with an e-commerce platform. In another dimension, they may be working with a GSTN platform. In another dimension, they could be working with their accounting folks through a digital platform as well. Now, what are some of the concerns that one has to keep in mind? That while the digital infrastructure, its portability, its ability to encapsulate information, cash flows, and repayments can lead to greater trust, it is not a substitute for prudent risk management at the level of the ultimate lenders. Can bad loans arise in this sort of a network? Of course. Does the risk of bad loans have to be managed? Again, yes, of course, because ultimately, when credit is provided, there is a risk of non-repayment simply because of lack of ability of the borrower to repay. I think the strategic reason not to pay becomes somewhat minimized through encapsulating the transaction on the e-commerce platform. As I explained earlier, a reputational hit to the MSME on the e-commerce platform from being a non-repayer of the loans could be massive. You could get excluded from being listed on the e-commerce platform in the first place. But of course, there will be an ability to pay problem, which is that they simply don't have the solvency or the cash flows. That could be bad luck, or that could be because maybe the loan was too excessive in the first place. Those are the traditional problems, classical problems that arise with any form of financial borrowing and lending transaction. Banks will have to manage the risks of that. Very often when new technology is available, there is an excess, an explosion. We have to manage the risks of that. Bank supervisory standards have to upgrade at the central banks to be able to deal with the risk of these kinds of digital loans. Data will have to be collected. As Patty said, I'm a big believer that data has to be used both for building models as well as for assessment of the models, and in policy and regulatory space, in order to assess that the credit scoring models that these platforms are likely to use are of reasonable quality, and that banks who are using some of these credit scoring models to provide credit, to the extent that there is unexpected loss, they are holding enough buffers of capital to absorb those losses, not just in the good times, but also when the cycle becomes a difficult one or in a stress scenario, so to speak. So let me end there, Patty. I want to thank you. Thanks to the organizers and the audience for your, for hearing me out. As I told you, many of us have been quite impressed with the clarity of thinking and the modular development of this digital infrastructure. It is not held or owned by a private enterprise. It's a public digital infrastructure. And in my view, this is the biggest advantage Indian digital finance may have over its global peers in the next decade.
Thank you. Thank you, Viral. That's absolutely brilliant presentation. I think many issues that you have flagged, the way we have to look at the future as far as the digital lending is concerned. There are a couple of questions which have come on the chat box. I think they are related in a way, so I will read them out and maybe add one of my own so that you can answer all this together, given that there are constraints, because all these are related. The one issue that has been raised is with this token in the picture. When there is a whole new way of credit expansion, will it happen for the unorganized sector? And if it does happen for the unorganized sector, what will be its impact on growth, inflation, and consumption? That's one question that has been raised. And the other is, with this all this AI technology in place and liquidity inflow in the market, do you think again it will have an impact on inflation? I think given your background, I think people want to understand how exactly this will play out, and will RBI manage inflation or credit and liquidity? That's the question. But the related question I have is, when we are talking about this interconnected world and the fintech, one thing that regulators struggle with, basically, if you look at last 10 years, take three big incidents: global financial crisis, Basel III was the result. COVID, it was rather easy, push liquidity into the system. But how to regulate fintech is an issue on which I think they have never come to a conclusion. Whether it has to be principle-based, whether it has to be activity-based, whether it has to be entity-based, or whether ultimately we go down the level of the product-based. So somewhere, unless we find the right balance, all these things of possibility could get stymied because of either over-regulation or get out of control as a result of under-regulation. So this is the dilemma that the regulators face. I think all these three are connected in one way or the other. So, Viral, if you could answer these issues.
Yes. Yeah, I think they are somewhat connected, as you said, but let me see if I can just organize my responses individually. I think the concern about growth and inflation in the world, including in India, in my view, is not so much that there is a trade-off. I think increasingly central bankers and the governments are realizing that that inflation is particularly a problem because it is effectively a tax on the savers. The average saver is at the lower end of the economy, in my view, in the sense that when inflation arises, it's a tax only if you don't have assets that are improving in value with inflation. And so they neither have the assets that improve with inflation, and their savings get eroded in real terms. So in my view, if growth is inclusive, it actually reduces the burden of being able to put up with a little bit of inflation when growth has to be resurrected, such as in the post-pandemic times. But if you have growth and you have inflation, but that growth is not inclusive, most of the growth is occurring at the very high end of the economic strata. I keep hearing about the distinction between what's happening in India in luxury cars market versus the two-wheelers market. That's not the kind of growth one wants. One doesn't want growth that's just coming through imports of luxury cars rather than actually also consumption at the lower end, like trickling down at the lower end. So in my view, expansion of credit at the last mile is a very, very crucial part of making the growth inflation sacrifice, both from an efficiency standpoint as well as politically tenable, actually. Because I think ultimately, if you don't have inclusive growth, it's a problem. It leads to a lot of difficult and sort of suboptimal policies being put in place, because then you have to quickly deliver a little bit at the last mile. And we do it through like just throwing credit at them, or we do it through a range of excessively costly, fiscally costly welfare programs that are not achieving too much in the long-term efficiency sense. Second, the AI technology problem, in my view, is slightly different. Think about the inflation that is taking hold in the world right now. We are basically pushing very high on demand stimulus through both monetary and fiscal policies. Fiscal policies more in the advanced economies, but monetary policies also in emerging markets. Why is the inflation rising so fast? It's because these supply chains are not able to adjust, both because of COVID and because of other kinds of things, such as the world wanting to be in a China plus kind of supply chain organization rather than being entirely dependent on one country. Whatever those issues be, and certainly in case of India's experience, a part of our inflation has always had this supply chain bottleneck sort of a problem, be it in food inflation, be it in manufacturing goods inflation that we are experiencing right now. In my view, many of the bottlenecks, again, can be relaxed if the ultimate supply chain components, each link of the supply chain, which in many cases involves MSMEs, can actually scale up. They can improve the kind of productivity investments that they need to make. In fact, this is a pretty important point, which is one reason why many MSMEs are unable to make productivity gains is because they are never able to build a reputation to be able to borrow long and in large amounts. It's almost impossible for them to own physical collateral of a large amount because they don't have the reputation to actually get a bigger ticket loan. If you can, through competition, through better validation of their data, through better encapsulation of their history, allow MSMEs to build reputation, I think each link of the global supply chain can actually become more efficient. And then when demand is being pushed, if the supply is able to respond more efficiently, inflation could actually go down. In fact, many think that digital economy has played a very crucial role in the low inflation that was experienced globally until the post-pandemic stimulus sort of pushed it to higher levels. The last point was on the complexity of regulation that will be required. I'm a big fan of regulating by function rather than form. Andrew Metrick and Dan Tarullo in the regulation space, they have called it as a congruence principle, which is roughly put, it says that if something quacks like a bank, then regulate it like a bank. Don't treat it as something different. I think ultimately that is what we have to focus on. Some thought needs to be given to whether it should be borrower-based regulation or product-based regulation. As you know, some success in macroprudential regulation has been achieved through basically lending limits, such as debt to income ratio or loan to value ratio, etc. Restrictions being put in the housing space, in the real estate borrowing space. I don't have a good answer as of now, but I'm absolutely convinced that excesses can happen in this form of credit as well, as we have seen elsewhere. There is some evidence where fintech has been studied more systematically, like in the United States, for example, that 70% of the expansion in fintech is simply because of arbitrage of capital requirements between banks and fintechs. 30% of the expansion is because the fintechs have better credit evaluation methods and are able to lend to borrowers that banks were not hitherto lending to, which suggests that 70% of the fintech expansion on top of that 30% of true value creation of fintech may simply be regulatory arbitrage, that banks face tighter regulations, fintechs are lightly regulated, so the credit sort of swaps over. Of course, then we have just transferred the problem from one part of the intermediation system to another. So I think regulators will have to be sort of on the job. I think I agree with you. The right thing is to not stymie the development of this altogether, but to ensure that you approach it in a principle-based manner. And there's something nice about regulating something that looks like a bank with similar prudential rules. I think we are reaching that space in case of non-bank financial companies. Certain asset liability duration mismatch problems were always there, but we thought NBFCs were small, why bother about it? Then they weren't small, and so now we are bothered about it. So I think it's better to react in advance, recognizing that some of the credit transition will happen from the traditional to the new space simply because of arbitrage of regulations. I think it's just a given. That's the way the finance organically evolves in any part of the world. So I think if I could just make one point, Paddy, which is, I don't think that the opportunity of fintech is necessarily in making better credit to those who are already in the credit space. In my view, the opportunity of these digital finance is at the extensive margin, is in expanding credit to a set of borrowers in the formal space who have not been able to borrow in the formal space. I think their formalization, their digitization, their ability to build reputations so that they can get bigger ticket, longer maturity loans, make productivity enhancing CapEx investments, is what will ultimately be the payoff from this form of finance. The reason why I'm stressing this is to say that the problem of their risk management, in my view, is the same as the problem of risk management with traditional lending. I think there is no substitute to paying careful attention to that, to having the right policies for that, and to have the right capital for backing up the model risk, the loan officer, over-exuberance risk, etc., that arise in other settings as well.
I cannot agree with you more. Viral, thank you very much. I think we have probably run out of time. Let me hand it over to Venkat to propose a formal word of thanks from my side. Thank you very much. Venkat, over to you.